Hey, welcome to this month's webinar from Blueprint. This is our January webinar, and we're going to go over the tax return roadmap, the 2026 version, which we'll be talking about the 2025 tax returns that will be coming out. Now, in January, obviously, nobody should be filing their taxes yet. I think the first day is going to be the 26th of January. After that, they can file. So you're going to start seeing these tax returns come up after January 26th, but more than likely not until middle of February. But this time in this presentation, I want to go over some of the changes and do, really an underwriting focused review of tax returns. Now, as far as what we're going to be reviewing here today, we're going to talk about lending versus IRS perspective on tax returns, right? Because as underwriters, we don't really care what your taxes are. We're trying to adjust the tax income to your gross income. Because, for example, you may make 100 grand W-2 at your job, right? But if you take, if you pay for healthcare and get 401k, your taxable is only 90. Doesn't mean you made less money. It just means you have less taxable. Same thing for the tax-based incomes like that. The next thing we're going to focus on is finding and documenting the income on the tax returns. And just let you know, the calculation part we're not doing here today. This is just a roadmap how to find them. We're not going to go over Schedule C, what to add and subtract, K1, things like that. We have other training videos for that that's separate, and we'll cover that in different videos. But this is going to be focusing on, hey, looking at the tax returns, understanding them a little better about how the IRS arranges them so that as an underwriter or a loan officer or somebody working on files, we have a good understanding of what we're looking at and what we're looking for. Now, first of all, the biggest thing about a 1040 is an executive summary of taxable events. Now, what I mean by that is every single taxpayer out there actually has a two-page tax return. Doesn't matter if you're in a dollar or $1 billion, right? Now, I'll agree with you if you go, no, Mike, that's not true. I had a borrower, had a whole bunch of businesses. They had like 600 pages. That's true. The amount of supporting pages does increase, but on every single taxpayer, I can look on page 1 and 2 of the 1040 and direct you to all their income, capital gains, K1s, real estate, royalties. It's all summarized on that two-page. Now, for lenders, again, the 1040 mainly points to income, but it does not calculate income in most cases. And that's what this roadmap is going to point out to you, that getting the 1040 is not the be all end all. Now, you can do it, and I call it in the horseshoes hand grenade kind of method, close enough. Like when I was in the military, horseshoes or hand grenades. Hey, as long as the horseshoe's close to the peg, or as long as the hand grenade's close enough to the enemy, it will do its job. But it doesn't mean it's accurate. It doesn't mean it's precise enough to be used on, on for exact income, things like that. All right, let's dig into this. So first of all, let's talk about how things are constructed. Now, one of the first questions we generally get is, again, Blueprint is an income calculation tool. Now, I've been underwriting for 32 years, 1994, I started the business. I was a processor loan officer first couple of years, switched to underwriting about 96, 97. So I've been in operations almost my whole career, minus a little bit of mix on sales and operations when I first started. And understanding the returns is always difficult. But if you understand how they're built and what's required, it'll make more sense. So one of the first things and questions we get is people like, hey, we want to send in the Blueprint the business tax returns, but they filed an extension on their personal returns. Well, that makes the business not returns not valid yet, right? Because all the guidelines, remember, in the mortgage business, we lend to people, not to businesses. So it's not like we're evaluating the business return like a commercial lender would. We need to know what they're going to tell the IRS about their personal. Because if you think about it, if you just give me 1120S's, one and one 1065, that person could have five 1120S's or five 1065s. We don't know. Or royalty that they're not telling us about. So the key trigger is they have to build all their business stuff and then we build the personal. So to build the business, the owner will collect all their 1099s and receipts and bank statements and put together a P&L, hand everything off to their tax preparer CPA. They will then properly organize it using a checklist and build out the 1065, 1120S, or create rental income on a Schedule E or whatever they're going to do. Then the second step is once you have those business returns built, like the K1 will kick over. Now you take your personal type wages, your 1099Rs from retirement, your W-2 wages from a job, 1099G if you're a big gambler making money, your K1s, things like that. Then you assemble those into your personal tax returns. And personal tax returns are the key to mortgage lending. Now, Here's how they look when they file, right? So this is kind of the mess that they put together. The 1040 is the summary. Now you may see a 1040 SR, a 1040 NR, which is a non-resident alien. You shouldn't really see any of those. And a 1040X means they have to submit that with the original 1040 to see what they change. So when you see a 1040X, you should get the 1040, and the changes on the 1040X should match the 1040. But for most part, you can just see 1040s. There's not any more 1040 EZs or 1040As like there was up to 2018. Those are long gone. Now, the next tier down, so when you look at if you get a tax return sent to you, the next set of documents you see is a Schedule 1, Schedule 1A, Schedule 2, Schedule 3. After that, the letters will come in A, B, C, D, E, F, H, J, R, S, E, and then 8812, which I know is not a letter, but it fits more in this form. And then some of these forms will have supporting forms like an 8825 will be attached up to a 1065 or possibly a Schedule C, or a 4562 will be attached up to a Schedule C. So, or 4797 attached to 1065. So these forms can go to a lot of different spots. So if you see them, they may be kind of like ordered a little bit differently. But this is the order you should see. Now, for the most part, remember, lenders are not using tax returns to figure out taxes. They're trying to figure out your income. So if you black out all the ones that are just only tax-based, they have nothing to do with what we do in underwriting, that gets rid of a lot of them. And you're going to start recognizing a lot of these forms, Schedule B, Schedule C, Schedule D for, for dividends, things like that. Schedule E, Schedule F, okay? So it's just, the forms we got to kind of understand, right? So we don't need to be CPAs, but we do need how to recognize how to find things, and that's what we're going through today. So this is kind of an overview picture, but let's go ahead and kind of show you what it looks like in real life. Now, before we get to that, let's also clear up the confusion about when you use tax returns. Now, from January 1st to April 15th, 2024, 2023 is acceptable. Now, with FHA and the government, of course, you got to get a P&L. Not so much required in the conforming, but your lender may ask for them, especially you start rolling close to April and you're trying to use 24, 23. They're going to say, hey, why don't you give us a P&L just to make sure that 25 is going to be okay. Don't have them audited. Just give us a kind of an idea if they're good to go. But according to the agencies, Fannie, Freddie, FHA, VA, USDA, 24 and 23 is good up to the tax deadline. Now, after February 1st filing, I could probably technically put January 26, although that's the day you can file. I can't imagine you get it back. You could use the 25, 24, but the key when this switches over is when they file them. Not when they're going to think they're going to file them, not when they've got them drafted and they're not turned in, when they've given them the IRS and you can prove they've given to the IRS. Now remember, the IRS is not going to respond back instantly, but they will also say, hey, we received them, and then you need to confirm that they got them and they accepted them. How do you do that? Well, the transcripts 456T comes back and shows it's filed, or you show that they owed money and they cashed a check, right, from the 1040. There's a few different ways you can do it, but you do have to confirm that that's actually what was filed last, okay? And IRS is, again, they're not instantaneous when they receive filing. It may take a while. So you could do the 2524 or the 2423 up to April 15th. But now once we get past April 15th, and I should correct my slide to April 16th, you really need to use 25, 24, 24, 23 is not allowed unless you file an extension. Now, this is where this is possible. Now the lenders may start asking for 25 P&Ls and why you'd extend and things like that, because it's a little weird when somebody extends and you're trying to use the income for 25. It's just really not possible. And if if you did extend, you have to do a 24, 23 and kind of prove the income is ongoing, right? So that's the only exception there. But once we reach October 15th, sorry, until October 16th, until 2026 filed, you're going to use 25, 24. Once you roll into January next year, now you can start looking at maybe 26, 25 when we're in 2027. So this is where, it sort of crosses back over the line of when you use what tax returns. Okay, let's dig into any changes. Now, the 1040s actually did change the way they look, but there's no effect on underwriting. It's just the lines are in different spots now. They got moved down and around. And I'll show you that in a moment. But on Schedule C, there was one minor change. Line 27A, which is referencing an addendum to to page 2 of the Schedule C, is now moved to 27B, and we'll show you that in a moment. But other than that, if you guys know the 2024 tax returns, good news. There is very little changes. I mean, obviously, maybe a little different font or spacing, but the line's the same, the layout's the same, things like that. All right, now let's look at that 25, 24 side by side. As you can see, there's a lot more data in the dependent area. That's where the changes happen. But if you look down at line 1A, it says, W-2s, line 1A W-2, or box 2A is tax exempt interest, tax exempt interest. And what you see happen here is, see how down here it says line 1A to 15, but down here it's 1A to 11. So the line 1 where we look for the self-employed returns is way down here at the bottom now, not up here a little bit higher. So again, layout's different, information's a bit different, but nothing that affects underwriting. It just has more data about, are you disabled? Are you a full-time student? Are you in the US? All these questions that they want to know about your dependents really opened up here. For the most part, everything else seems to be pretty much the same. A couple different questions here, all tax related, not income related. All right. Now let's go through the roadmap. If you're a loan officer and underwriter, how do you identify different kinds of income? So I've got my 25 tax return and I roll down, I see that you have W-2 wages. Now remember, this is an executive summary. So if I have two taxpayers on here, you could look at this line 1A and it could say $300,000. You have no idea whose it is. Is it taxpayer A or B? Is it one W-2? Is it 27 W-2s? You don't know it. Also, W-2 wages mainly come from employment, of course, but if you own an 1120S or 1120 or sometimes a Schedule C single member LLC can kick out a W-2 even though you're self-employed. That's a big misnomer about W-2s that we get quite often in our support box is that people will say, hey, W-2 is a job. It can't possibly be from self-employment. Well, it is because like Blueprint Solutions is actually an 1120 S corporation. I'm one of the founders. So I'm both a owner and an employee of the company. I get paychecks. I get 401k wages taken out. I get healthcare taken out. I get taxes taken out of my paycheck. I get a W-2 because I'm employed by the company as the president, I guess would be my employment title. But I'm also one of the owners, so I get K1 income. So that's how that works. Now for an 1120, I would get W-2 wages only and then dividends, not K1. But it's still, if I'm over 25% owner in our world, you're still self-employed. Because remember, in the tax return world or the real world, if you own any percentage of company, you can say you're an owner, even if you're 1%. But in the mortgage world, you have to be 25% or greater to be considered self-employed, where the self-employed rules start kicking in. All right. Again, we're not going over calculations today, but just to make you aware of W-2 wages could be from self-employed. So if you're looking for, income and you notice 11 W-2 wages, don't write it off yet until you see what kind of other incomes they have. Now, next thing down that you're going to notice is interest and dividends. Now, many people again will say, hey, you have the tax returns, just use those, you don't need anything else. But the problem is the guideline requires you to read the Schedule B and look at the statement sources. Now, the exception that would be like FHAs, like, hey, up to 3 grand, don't worry about it. And if you have a loss, you got to take it. Where conforming doesn't really take that stance. If they take a loss, they don't really have you subtract it the way FHA does. And so it's a bit different for the government FHA versus the conformings. But if I've got interest and dividends, I can't just say, well, I'm going to take it. Because what you have to do now is you have to look on the Schedule B, which is referenced here on line 2A and B, and you have to see how you got the interest. What is it from? Is it from your 401k? Did you give a land contract to somebody, which would have a whole different set of documents you need to validate that land contract, or a personal loan, or whatever it is you gave out? Right? And then the dividends, right? Where are they coming from? Is if they're 1 year they're from Tesla and the next year they're from Amazon, right? And it's inconsistent. Well, you're supposed to have a 2 year history of getting them and then be consistent. So you could argue that they swap and they're consistent, but you have to know what's going on. Because the other thing too is you have to prove that they currently still have these type of things. If I got dividends up to end of 25, I could have sold them in January 26. So this is June of 26. Maybe I got rid of all of them for a down payment. So you need additional information. You can't just take what you see on the tax returns. You have to go to Schedule B and then do some confirmation about the sources and document it properly. The next thing is your IRA there. So if you got IRA, which is individual retirement account, basically a self-funded retirement account, right? It's not a 401k or a 403b or anything like that. You have to do some more documentation. So first of all, we don't again know who got it. Was it taxpayer one or taxpayer two, right? So we have to see what they got, and then we have to 1099-R to show what it came from. Now, if this, remember, this is a self-funded retirement account. In other words, you saved up the money, so it can run out. If I'm pulling 4 grand a month out of my IRA and there's only $40,000 in it, that's only 10 months of income. And all income requires a minimum of 36 months or more to be used. You can't be using any income that only has 22 months, 12 months that you're aware of. Like employment, you don't actually know unless you have like a termination letter or a retirement letter. But like divorce decrees, you can't use unless there's 36 months. Child support, 36 months. Royalties, 36 months. Same with IRAs. So you can't use that. So you got to look at the statements on top of the 1099 and see if you have enough and where the sourcing of it is to make sure that they A, have enough to continue on with it. The next thing is your pensions. Same kind of thing. Now, the 1099 from a pension, you don't need to source if the pension is funded. Those are all generally federally insured, like a bank account. If you retired like my dad did from the Crane Operators Union, and he's 80 this year, he's been getting retirement now for, I don't know, he retired at 62, so 18 years, right? I don't go to the Operators Union and say, hey, do you have enough money to pay his retirement? They have to. I mean, they legally are insured and things like that. So that being said, you just get the 1099 and confirm who it belongs to. The next thing, Social Security benefits for the same reason. Now, this one has the I before E except after C exception. You could actually just use the tax returns for Social Security if there's only one taxpayer on here. Okay. Or, and this is a little more gray, if there's two taxpayers on here and they're both borrowers on your loan. Okay. Because this is only can be from that type of thing. Now, the other thing too is if your borrowers are 40 years old and they're getting Social Security benefits, you need to kind of see if it's retirement or long-term disability or if they're getting it for a dependent child, things like that. So that's why it's a little gray. You're better off using award letters and 1099 SS, for the Social Security. Don't just use the tax returns, but in a pinch, you could use it, but you can see the downfalls to it. Now let's address another kind of elephant in the room about taxable versus non-taxable income. What are these box A's for versus the box B's on the right? Why is there, what do these mean? So what's happening here is the center box is what they received, but the right-hand box is what's being taxable. So if I'm going to write out the math formula to figure out non-taxable income, which can be grossed up, I take the total amount, box A, minus the taxable amount, box B, gives me my non-taxable amount. All right. Now, if I divide the non-taxable amount into total amount, it determines the percentage of income that is non-taxable. Let's break it down to a number. Box A says 10 grand. Box B says 7,000 is taxed. That means $3,000 is non-taxable. $3,000 divided into 10,000 total is 30% of the income. This means that I can gross up only 30% of the income. So 10 grand times because remember, when you get an award letter, it might be higher than the last year's filed tax return. So you want to figure out the percentage of non-taxable. So 30% of the income is 3 grand times the gross up rate for for Fannie Mae is 25%. That's 750. Add the 750 on the 10 grand. That's 10,750 divided by 12. That's 895.33 per month. All right. That's the, formula for grossing up any taxes. Now, good news, if you're a Blueprint customer, right, you just put in the data in there, 10 and 7, it does all the rest for you. And the award letter amount, right? We gross it up, we show you how we do it, we do all the automation, right? This is the great thing about automation. It does all the work for you, so you don't have to sit there and hand add it up. Because I've been trained underwriters for, I don't know, 22, 23, well, 2000, right? I started being a supervisor in underwriting. So 26 years now I've been training underwriters. So I'm always telling them, like, look, underwriting math is not trigonometry or calculus. It is algebra. But if you get in a component in algebra wrong, like if you got A plus B minus C plus D times, X, if you get X wrong or C wrong, the whole formula goes out the window. It's really easy to make a math error because algebra has a lot of moving pieces. And the software is does that all for you so you can just kind of overview it, not worry about did I divide it right, did I subtract it right, did I hit the limits right, things like that. This is a great example of that. This is not hard math. It just takes a little while to work it all out manually and easy for you to carry a decimal wrong or do something wrong here. Okay, now the schedule one. This is the most one that's most asked about. So the schedule one is basically the pathway to other incomes that we're most interested in, your self-employments. Now the schedule one is way down here. If you see something on schedule one, that's your indicator that you have some self-employment income possibly, because there's a lot of things on schedule one. But let's take a look at the schedule one. A couple things about it. So again, this is going to be referenced here. Line 10 is what you see on that here on line 8. Okay, so this is going to say 50 grand. This will say 50 grand. Now, a couple fun things about this. Now, remember, this is referencing both taxpayers. So you can't look here and go, oh, I see a Schedule C. I know it's Bob or Judy. You have to get the Schedule C to figure it out. This is just pointing you to more information. So a little bit of fun items about the Schedule 1. So first of all, there's a couple different incomes. Before we get to it, let's talk about something that this is totally just a non sequitur, but this might be a little bit of politically charged statement. I'm not making it political, but you ever heard anybody say corporations don't pay taxes at all? It's just not true, right? They do pay taxes if they make money. Now, if you don't think that's true, let's look at the IRS and how detailed they get on you. My favorite thing here is looking at this Schedule 1 about taxes and seeing how they kind of grind down on you. Line 8A, other incomes. Gambling. Okay, if you make some money gambling, we understand that. But check it out, jury duty pay. Hey, don't forget about that $35 you earned when you spent the whole day in jury duty. Normally you might earn $50 an hour times 8, but that 35 bucks, you better tell us about it. How about this? You're an Olympic gold medalist or a Paralympic gold medalist, and that gold medal has some value to it. It's not solid gold, obviously, or they'd be a multimillionaire, but there is some gold on it. There is some silver on it. There's some bronze on the other one. Don't be forgetting to tell us about that. Or if you got any prize money, make sure you tell us about that. Come on. Or while you're incarcerated, that $2 an hour you're making to do some roadside cleanup, don't you dare forget to tell us about that. Right. So look at where the IRS drills down to. So we know that things are taxed, and that's why this tax roadmap is important because everything you earn is pretty much taxed. Not quite everything, nearly everything you earn is taxed. And so those nearly everythings will be on the tax return in some spot. Okay, now let's get back to the tax return roadmap. So first of all, in the Schedule 1, there's another kind of income here, which is alimony received. Okay, so this is confirming you got some money income. Now, the thing about this is there was a law in 2019 that passed that if you started getting alimony in 2019, the person paying it pays the taxes. The person receiving it no longer pays taxes. So if you happen to have a very long running alimony, which at this point it's 2026 and 19's, 7 years away, possible, not probable, but this will tell you if you can gross it up. Just like child support's always been tax free. That's why there's no listing for child support anywhere on the tax returns because when you get it, you don't pay taxes on it. It's just the person that earns it pays the taxes on their regular income, and then they issue you your tax or your child support without paying any taxes on it. All right. So that's what we're doing here. Okay. This is just kind of showing you the differentiator. Most time you can gross it up, but you got to confirm it. Next thing, Schedule C. Now, this is where the roadmap comes into play. We have to know where to find everything at. So here's the workflow. I go to the 1040, I see you have a Schedule 1. It lists that you have Schedule Cs on line 3. The next thing I need to do is get your Schedule Cs. Now, the little trick about it is line 3 could be referring one or many um, uh, Schedule Cs. So let me go ahead and share. I'm look over my left here and share a different screen here. And this is going to have all the tax forms in the, okay, so let me share this. And let me pull up that first Schedule C. Should not be anything too surprising to you. Let me go full screen here. All right, so come down here and line 31. This line 31 tells you that you got to reference it back up on the line 3. Okay, so if you have multiple of these, and this says 50 grand, but line 3 says 20 grand, or 90 grand, that means you have some losses or gains in other Schedule Cs that you need to find. So just be aware that you got to kind of match those up. Let me go back to the roadmap. Okay, so back to that. So make sure you do your math and compare them all up, and that's what we're talking about. The next thing is Schedule E's. Now, the Schedule E contains a whole bunch of different things. So here's the workflow, 1040, Schedule 1, Schedule, and I put E and the plural there can happen. Now, the plural only happens on the rental, the royalty section. We'll talk about that in a moment, not on the pass-through entity or trust income. Well, trust income possibly, but I don't think, I've never seen it. They just generally say see addendum 4 or whatever. So the reason this is just kind of like a little why behind the what. Schedule E is a tax multiplier or adjuster because Schedule E talks about passive and active incomes. And there's a rule that says you cannot take any passive losses against active income. So, in other words, I can't work a job and lose money on my rental property and write off my job's taxes. Right. So that's why they have it. Schedule E is that adjuster for passive versus non-passive. So this is why they do it. Okay. So anyway, that's the reason why I always like, why do they jam all four of these on one? Why don't they put a R for rental and R1 for royalty and Schedule K for K1s? And that's why it's an adjustment form. But this is how you kind of navigate the Schedule E. So here's the Schedule E, and here's the basically four types of income. Part one is your rental properties or royalties. Royalties is pointed out down here. So that's one, two kinds of income we look at in underwriting. So if you see line A will say 123 Main Street. A here will say it is a single family residence or vacation rental, which is very important to know as an underwriter because in conforming world, you only need to do a 1 year analysis on a single family or a multifamily that's not short-term rental or commercial, as a matter of fact. All right. But if it is a vacation or short-term rental, you have to do a 2 year analysis, and this will tell you about the property, right? So if you see a two, you got to do a 2 year look at for conforming. Now, government always wants 2 years. Well, FHA, VA want 2 years. USDA wants 1 year or less. They actually use more of a lease kind of agreement. But anyway, not to get too deep in calculations, but just FYI. But you want to look at that and go, okay, I got an address. So line A is 123 Main Street, and they brought in this much rents. And of course, you're going to do your Schedule E calculations depending which agency you're going to do. If you see royalties received, this may say, Part C is, royalties from Michael Jackson backup singing Thriller, right? And they may get a lifetime royalty of like, $5 every time the signs, or an album sold. Who knows? And that's a very old reference. Again, I'm almost 57, so I'm going to reference things a little bit older. But, the revenue be here and your expenses here, that kind of thing. Now, the key to this file is if you own 9 rental properties, you will have 3 of these. And what should happen is the first and second one should not have line 26 filled out because it's more of a summary. But once you get to line 26, it should have all 3 of them listed. So the total gains or losses added up should total up on line 26. That's how you tell you're on your last one. And line 26 is also added here on line 41. Now, for Schedule E, there is typically, I've never seen any difference. I'm 99.9% sure, only one page of this. And the reason I slightly doubt myself is this RMIC really weird, income, or the trust, there's only 2 lines. Every time I've seen they've had more than 2 trusts, they just say see statement 27. Just like when they have more than 4K1s, they'll say, K1, 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 and see statement 3 or whatever it's on. But anyway, the second part lists all those K1 incomes, which we'll talk about more in detail in a second. And then the trust incomes, same thing here. So you can have multiple page ones, and the summary will tell you the total, and you should see that they all added up into here when we're talking about all the number of rentals. Okay, now let's talk about this second section. This is where you see your K1. So here's the workflow. I see the, 1040, Schedule 1, Schedule E's. I look at your Schedule E's. Here will be a list of the names of the company and what they are. Remember, pass-through entities, there's 2 types. There's a 1065 partnership or an 1120 S corporation, S corp. It'll say P or S, right? It'll tell you it's partnership or an S corp. It'll also give you their EIN number. The EIN number is just like a social security number for a person. They identify one business and one business only, just like your social security number identifies you and you only. And when you die, your social security number is retired and removed. That nobody gets it in the future. So this says Mike's Airplanes. It's a S corp, and they'll have an EIN number that's the same 9 digits that your social security, or is it 10 digits? 9 digits, right, as your social security number, right? So it's a different format. It'll be one, two numbers dash the other seven, where your social security number is 3, 2, 4, right? So they're the same number. They just have a different dash in there. That's how you can clearly identify the right one. Now, again, the problem here is we don't know who these belong to. They could be taxpayer one, taxpayer two. So even if you're underwriting and they say, oh, that's the co-borrower's business, you have to get the K1 to prove it because we don't know, right? We have no idea. Or maybe use data verify to validate it, but you got to figure out what's going on here and prove who owns what because, if you have a loss or you have a self-employment, you got to figure out the ownership percentage to see what you got to do with it. So once I identify that this first one is a partnership, Mike's Airplanes partnership, EIN, then I would ask the borrower for their K1. Now the K1, it should match the name and the EIN. This should be your borrower's name. And for a partnership, this is where you get percentage ownership from, the ending capital. It doesn't matter what the profit and loss say, the capital is what tells ownership. I don't know why that is exactly. I mean, CPAs agree with me. They're just like, that's just what it is. Fannie Mae has it in their guidelines. If you want to check me on it, if Fannie Mae does it, they all do it that way because the rest of them don't do a good job explaining it, but Fannie Mae does outline it. So this is there. And of course, we're going to look at income from there, right? So we got guaranteed payments, 4C, right? We got lines 1, 2, and 3, which are usable, and then the distributions to prove they received it. Again, we're not doing calculations today. But if you see this as 25% or over ownership, that means you have to ask for the business returns in most cases, except for Fannie Mae, which may let you have an exception to it, right? The rest of them require it. So you got the K1, you see that they are 25% owner, and then you got to match up the right business, which of course you have the matching name and the matching EIN, and then you're going to do your cash flow adjustments, right? So that's the workflow. If you're a loan officer and you're getting tax returns, this is what you should be asking people for. Hey, when you get their Schedule E, go, hey, notice you have three K1s on here. Who owns them? Oh, it's my wife or me or whoever. Great. What's the percentage of ownership that you actually are? Oh, I'm 50%, I'm 12%. You still have to get them all. And then when you get these, then you can say, well, I also need, hey, for those ones that you're 25% or greater, I will also need the business returns because we have to do a cash flow analysis on there. All right, so that's your walkthrough. Now, 1120 has the same exact pattern. You see it on the Schedule E, it says it's an S Corp, you see the EIN, you get the EIN, you match it up, you get the right borrower, there's your percentage of ownership, there's your incomes that you can use, there's your distributions to support the income as required for Fannie Freddie, not so much for government, right? And then if they're over 25%, get the business return, off we go. And I noticed my slide presentation, I actually accidentally clipped the clipper in there, so I got to fix that on there. But that's how that works, okay? So this is how you find and drill down into K1 type incomes. Now, I want to point out a couple things. I put these red arrows up here for a reason. Make sure from a quality control standpoint, a lot of times I see errors where if this says file K1, this means this person is no longer involved in it. Doesn't mean the business went away. This means the income or losses no longer have to be counted. And this also shows you if they're less than a year. Don't skip this. Most of the time, these will be blank. That assumes it's a full year then, but if they're filled out, make sure it says 12 months. That's a quality control check you got to do. And our software actually look at that when you upload things to us too. All right. Let's go over the real quick the trusts. Now, this is also a very common misinterpretation. I don't know why. A lot of people, we have trusts very commonly. Mostly people have living trusts, right? A living trust is just a will. I have a living trust. Nobody's paying me from the trust, but my wife and I are married, right? We have assets. So if her and I, God forbid, are, driving down the road and we both get killed in an auto accident or, flying an airplane or whatever, the living trust just transfers all the things that we own, all the assets into the trust. So they're not put in probate, right? So we're both the trustee and the beneficiary. So we can move them in or out all we want. It's just like it's an extension of us. It's not an income thing. So, whenever people see trust, they're like, oh, I got trust here. Yeah, well, so what? Their house is in the trust. It's not going to produce income for them unless it's a rental or something like that. All right. Now, what you're looking for is irrevocable trust. Now, if you own an irrevocable trust and you kick over your business to it, you can never get that business income back. It becomes ownership of the trust. Now, you may be the beneficiary of that trust, then that's fine. There's a little bit of documentation there. But typically speaking, the trust that you generate income from is the one like your grandparents set up or, some other foundation that you're part of, right? That's what you get. And then you got to get the trustee letter. Hey, do you pay Mike 5 grand a month? Yes, here's the evidence for the last 12 months. Here's the evidence. We can definitely pay them the rest of their life, blah, 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 right? You get that trustee letter. I think a lot of people mixing up the irrevocable and the living, right? That they're very different. They're both trust, but they're very different flavors of what happens. Okay. Now, last thing too is line 41 should match up on the Schedule E. So all those things will match up. If you see this number and you look at the Schedule 1, it will confirm to you you have the right one and you've done your quality control properly. All right. One more easy one, then we'll talk about the weird one, the 1120. Back to this, we passed the E and now we're back on to farm income. This is just like the Schedule C, same exact concept. You see it in here, you know they have a Schedule F. It should match, it'll tell you who owns it. And the bottom of Schedule F, line 34, it'll say 5 grand. If it matches line 6, 5 grand, good. If it doesn't, there's more Schedule Fs you need to get, just like Schedule Cs. Pretty simple. Okay, on the 1120. Now, this is one of the more confusing ones because guess what? The 1120 does not show up anywhere on your tax returns, right? It is a separate entity. So it's not like it just it can live on its own. You guys own, if you have any kind of 401k or stocks, you own part of 1120. So it works independently. It can make money, can lose money independent of its owner. All right. So you're not going to see in the personal returns because it pays its own taxes, things like that. Now, how do you find these? Well, as an underwriter, here's what I was taught. If I get an application, well, first of all, the loan officer, you should ask the borrower of ownership. Hey, what do you do for a living? Oh, I own a hardware store, Ace Hardware. Oh, you own it? Yeah, I bought the franchise. I'm the boss. Whatever they actually do there, the key thing is they're the owner. Well, what percentage owner are you? 100%, 50%, whatever. That's what the loan officer should be asking, passing along the underwriter. Now, if that doesn't get passed along for whatever reason, if I'm underwriting a file and I see that you are Mike Whitbeck and you work for Whitbeck Airplanes, I'm going to ask you, like, hey, your name matches and you're the president of the company. Are you one of the owners? Do you have ownership? That's always the question, right? And the other way you can find out is if they do give tax returns for any other reason, and you see dividends in a Schedule B, 1120s only push out money to the owners one of two ways. If I'm an owner, I can be an owner and an employee like the 1120S I described earlier. I get W-2 wages, but as an owner, guess what I can also get? Dividends, right? Dividends are code word for profit. So if you have ownership, you get dividends. It's not like a stock where, I mean, you can have stock dividend paying stocks, but most companies you're going to see are not. Most 1120s you're going to see in the underwriting world should not be on the NASDAQ or SEC or anything like that because there's no way that Amazon, I don't even think Jeff Bezos owns 25% of Amazon. He's the owner of it, but he doesn't own the majority of it, right? Or like Elon Musk owning Tesla or whatever, right? Yes, he's an owner, but I don't think he owns 25% of it because there's just billions of dollars in stocks out there, right? So you're never going to see one of those. You're going to see a dividend paying, 1125E. Oops, sorry, let me put the 1120. I'm sorry, 1120, not 1125E. So 1120, again, nowhere on here will tell you an owner. So you have to get a couple of information. So you look for it in kind of a quality control. If you determine it might have ownership, you want to ask them about the 1125E. And remember, you can't use pay stubs once they become 25% owner. Now, the other thing you could probably do is get a letter from another officer at the company and confirm their ownership. But if you get the 1120 and you see compensation officers, they should have the 1125E. It says name of officer, social security number, percentage of time devoted to business. This could be 100%. You're not an owner. Officers don't have to be owner. Owners don't have to be officers, although I've never seen one where they're not. Okay. But if you also devote 100% of your time, it does not mean you own the business. So you're going to look at this, common and preferred shared. And if these total up to 25% or greater, you're self-employed. Now, amount of compensation should be your W-2, but sometimes you also get like non-W2 wages like healthcare or whatever. So this can be off. The W2 is preferable, but you could use this in a pinch for wages. But the key thing here is this 1125E will tell you percentage ownership. If they don't have one, you're going to have to get some other confirmation about how they ownership. Let me go ahead and switch it back to the presentation. Back to the presentation. That's what I mean about getting the percentage ownership. Okay. All right. Well, hopefully that roadmap's been helpful and we've done our best to present all information accurately. Of course, check the guidelines for any interpretations of things. But if you have any questions or you're not a customer, get blueprint.io. You can get a free trial and check out our software. If you have any questions about this presentation, info@getblueprint.io. Happy to answer you. This is our support box, and I hope this information has been helpful to you. All right. Thanks for joining today. Have a great day.